August inflation data is one of the latest reports that comes out before the Federal Reserve meets for its policy-making committee in the middle of September. So what can investors take away from the new economic data and how to allocate their money? Let's bring in Goldman Sachs asset management client investment strategist Elizabeth Burton to give us her insights. Great to have you here in studio with us.
Good morning. Thanks for having me.
So a lot of people are wondering, coming off of the CPI report, even if the Fed is expected to stay put in September, how they position themselves for some type of potential move in November.
Look, it just came out. Our economists are still digging through some of the numbers. And I think what's most important is that the clients I work with most closely, the institutional investors, are not going to make a lot of decisions off of this number. We still need to see additional data points. But I also think a lot of the number came in line with expectations. And there are some nuances here and there, but not enough to make major market decisions, most likely.
Those institutional clients you work with, what are they most concerned about right now? I mean, there are a lot of risks to choose from right now. So I'm curious kind of what they're prioritizing or what's of highest anxiety, for lack of a better word.
It depends by client, obviously, but one of the most common questions I get is when can we add duration back into our portfolios? When can we add, the longer bonds back in? And that differs on the retail side and institutional side. We've seen the retail side adding money back into money market funds and fixed income and longer duration more than we've seen the institutions. Either they never took their duration down or they're hesitant to add it back in. And I can understand that sentiment. If I was, still running institutional money, I may think, well, the risks could remain to the upside for another hike. Potentially, I don't want to add here. But our research shows that now is about the time, based on the hiking cycle, when the 10-year actually should perform better, and you should consider adding duration back into your portfolio where you can.
And so, are they looking outside the U.S. right now? And if so, to what extent? What pockets more globally are they looking at?
Of course. So our ex-U.S. investors are certainly looking outside of the U.S. and are looking globally. Our U.S. investors, for the most part, are still hesitant to invest outside the U.S. It has been a good place over the summer with, the rip in U.S. stocks to sort of add your incremental dollars. But going forward, I think all institutional investors need to think about geographic diversification. That can be really hard. A lot of folks still aren't traveling post-COVID. But I actually think diversification on a geographic basis is going to become much more important in years past, when we mostly thought about diversification between equities and bonds or commodities and cash, et cetera.
So given, turning now sort of more to equities and what we have seen thus far this year, the sort of rally and now a little bit of a sideways to down movement, going into the fall, going into a little more uncertainty around when the Fed is going to be done, are people sort of hedging? Have we seen an uptick in that kind of activity? How are people managing their risk right now?
That's another top question I get. Should we be adding risk mitigating portfolio strategies, outright hedges, or strategies with more diversification? I've heard a lot of talk about hedge funds coming back, commodities. Actually, most institutional investors removed commodities allocation years ago. Now they're considering adding it again. Obviously, it depends on what your goal is, whether or not you should add an outright hedge. But there's less likelihood there's going to be a massive potential sell-off in the next couple months, and this choppiness may continue. In that case, investors should weigh whether or not the cost of adding a hedge is worth kind of sitting through it. As you both know, usually when we get some of these market announcements, the market drops and then rebounds, right? So it may not be worth a hedge, but certainly diversification, particularly if inflation stays stickier for longer, that diversification you get from bonds didn't hold up last time, it should do better now, but you may want to think where else you can reduce your equity beta or your equity risk.
Are you starting to get questions already about next year, about a general election year from some of your institutional clients?
Not too much, and that hasn't quite started yet. We're still getting questions mostly on Fed action and inflation, but I imagine that'll pick up in Q1.
And how much, if at all, and I don't know if you even talk about alternatives at all, but I am curious how much clients are looking at that right now, particularly given all of the talk around commercial real estate. if people are sort of staying away from those kinds of areas at the moment?
Conversations around alternatives are very popular, not just on the institutional side, but also on the RIA side and private wealth side. It can be a good diversifier. It can also help you sort of maintain your portfolio exposure with the volatility and not, you're not able to sell in some cases, so you can kind of sit through it until the rebound. But mostly for its high return potential and diversification potential. So a lot of our conversations are revolving around that. On the commercial real estate front, the chatter on that has died down a little bit, but I do think folks will start to look for places in the markets where capital has flown out over the next 1 or 2 years and start to think about where those opportunities might come.
And the conversations on alternatives, I'm curious if is that something that waxes and wanes, or have you just seen sort of like a straight line up in interest in those kinds of vehicles?
No, great question. One of the most interesting anecdotes is I hadn't heard anyone use the term portable alpha, which is basically futures exposure to excess hedge funds in a really long time. And it's come back this year. Also, I'm getting a lot more calls from clients asking about certain hedge fund type strategies, risk mitigating strategies, even equity long short, going long and short. The equity market has picked up in parlance a lot, and that's really not something I had heard, pre-COVID. So folks are out there searching for a way to get incremental yield and diversifying their portfolio because they're worried, what if this happens again? And maybe not a COVID event, but an event like this that, sort of reminds us of the GFC, sort of reminds us of COVID when we saw both equities and bonds sell off. And that's really uncomfortable especially if you're 60-40, if both sides of your portfolio are taking a hit.
Really interesting.
I think Portable Alpha is going to be the name of my next album. It's too good.
I like it.
It's too good
Portable
to let go.
Alpha.
Yes.
Elizabeth Burton, thanks for your insight and for your album ideas. Goldman Sachs Asset Management Client Investment Strategist Elizabeth Burton. Appreciate it.
Thanks for having me.
Thanks.